Greetings. Today is Monday, June 1st, and May was another very strong month in the US stock market, or was it? On the screen right now, I've got a monthly candle chart for the S&P 500, and you can see I'm highlighting the month of April and May. If we look at a daily chart, again, you can see a very strong month in the S&P 500. If we break this down into a weekly candle chart, you can see 9 weeks in a row, the S&P 500 finished higher. So 9 very positive weeks in a row. That is a heck of a rally. Or what's going on? This is the value line geometric average. And if you recall, the value line measures a much broader section of the United States stock market, and it is equally weighted. The S&P 500 is cap weighted. So this is the daily value line geometric average. If we look at the weekly chart, this is what it looks like. It doesn't look nearly as strong, does it? If we put them side by side on the left-hand side, now you have the value line geometric average, and you can see really only up 1% for the year versus the S&P 500 is up about 10, almost 11% for the year. So has this really been a very strong market rally, or has it just been a rally driven by tech and specifically AI? On the screen, I've got a tweet from James Bianco. He's highlighting that since February 27th, the S&P 500, that's this black line, is up about 10%, but the blue line is the S&P 500 without the AI stocks, and over that same time period, that measure is actually technically negative. So if you're looking at the broad indices, these last 2 months have indeed been very strong. But in order for us to be in a robust, thriving bull market, we need to see strong participation across the board. Have we gotten that? On the screen right now, I have the S&P 500. We have a daily chart in the top pane. The bottom pane is percent of the S&P 500 that is trading above the 200-day moving average. And on the far left side, you can see there was a period back in 2016, 17, and into 18 where for more than 24 months, we had very strong participation across the board. In 2021, going into 22, it was about 18 months. In 2024, it was just those 12 months. And then last year, a bit more of a struggle. It was really only 8 months. But let's zoom in to where we're at right now. And what I want you to see is as the S&P 500 is moving higher on the price scale, in participation, it was actually going down. That is a divergence, and that is a warning sign. Again, if you understand that the S&P 500 is cap weighted, if you see something like this, what it's telling us is the biggest stocks are moving higher, but there's not a lot of support. And the constant analogy that I use here is military. If you've got the generals, the big guys, if the generals are advancing but the soldiers are not following, that is a military campaign practically doomed to fail. You have to have the generals leading, sure, but you've got to have broad participation from the soldiers. And what we saw in the S&P 500 is weakening participation. Now, I believe this is May 20th. We finally saw a bit of a trend change. And so late in the month of May, we did see some participation start to improve. Now, let's look at the small cap. This is IWM, so the Russell 2000 small cap, which is also cap weighted, by the way. But you can see some of the same things. You see the index was moving higher, but you've got participation weakening. So a little bit of good news, bad news. The good news is towards the end of the month of May, we were seeing signs that the market was broadening out. The participation was broadening out, that the more and more stocks are starting to participate. The bad news, or the concerning news, is that we are also seeing signs that the key indices are becoming a little bit stretched. What do I mean by that? Well, on the screen, I've got a ticker symbol that's going to remain anonymous for compliance purposes because we sold this on Friday for the reasons, in part because of what I'm describing here. So what do I mean when I say stretched? The market is stretched. Well, if you look at the red line, that's our 200-day moving average, and this particular position was up 41% away from its long-term average. Short-term average, it's about 22% higher. So when something gets that stretched, that far away from its moving average, that's what we mean when we say stretched. It's naturally also very likely to be in an overbought condition. Now, something can stay in these overbought conditions for quite some time, but in our tactical models, we're going to try to sell this into strength. And by the way, this particular position is down almost 5 or 6% today. So I'm happy that we sold this. We're selling into that strength. That's on an individual sector. But if we look at the broad markets, this now again is the S&P 500. But you can see the red line again. The S&P 500 ended the month of May approximately 11.5% away from that long-term trend. And on a short-term basis, about 5% higher. But notice the black line and where it is in relation to price. Over on the left-hand side and through the middle of the screen, price is right there with that black line, versus now it has become a bit stretched. So the key indices, the S&P, the NASDAQ, the Dow, all of those things, we could easily see those pause a little bit. And we see that again, the RSI is again in an overbought reading. But that doesn't necessarily mean danger is around the corner. It just means that we might see those indices pause a little bit, and that's okay. That's allowing, if you go back to the military analogy, the generals are pausing, waiting for the soldiers to catch back up. Now, if we look at the NASDAQ, as I'm going to show you in just a few minutes, this has rip-roared higher, and you can see it's even more. It's even further stretched from these two moving averages. If we take a look at the advanced decline lines, remember the advanced decline line is the amount of stocks that are advancing minus the number of stocks that are declining. And so on the screen, I've got the S&P 500 and that advanced decline line. You can see again, the price is moving higher, but the advanced decline line is technically moving lower. So that was a concern. If we look at IWV is a Russell 3000. Again, same thing. We've got the price moving higher, but the advancing stocks is kind of moving sideways. That is a bit of a concern. Again, IWV cap weighted. So let's now broaden our own view. On the screen, I have the year-to-date performance for the 11 sectors of the S&P 500 plus commodities. I think I also have metals in here somewhere right there. And so what I really want you to see is this bifurcation that I've been talking about. You've got 3 different sectors here at the top having very strong years, but then there's an awful lot of clustered here towards the bottom where it's just been meandering sideways just a bit. So that's what I'm talking about, is this bifurcation where commodities and tech, they're doing great. Everything else is a bit of a struggle. Look at this down at the bottom. That's the financial sector. The financial sector is a pretty big component of the United States economy, and that's negative year to date. That's not good news. And if we zoom in and just look at since March, again, you see tech has just blasted off, up 37% since the beginning of March. But look at everything else. Everything else has really just moved sideways or is even negative. Again, this is metals and mining down 15%. You've got consumer staples. Consumer staples are still negative 6.5% since the month of March. So March, April, and May, they're still negative. That's not good news. So let's switch gears and land the plane by looking at some economic data on the screen. This is a chart that I showed from last month where we talked about the difference is trend following. It's not trend anticipation, but I've just updated it for the month of May. And again, this is Brent crude. You can see a massive move higher for obvious reasons. We won't get into that. But since these highs, Brent crude is down about 30% or 27%, but it's still higher, almost 27%. So good news, bad news is a bit of a correction here. Bad news is it's still very elevated. If the price of oil continues to come down, I would argue that's certainly good news for the economy. If it doesn't, it's going to be harder and harder for the economy to really move higher. That said, we also talked about this last month that the 2-year yields are forecasting an increase in the Fed funds rates. Lots of folks are wanting the Fed funds rates to be cut now that we have a new chairman. Hey, let's cut those rates. That's not what the futures market is suggesting. The 2-year yield is moving higher, and actually, as I'm recording this, it's even higher than what you're seeing on the screen. That is forecasting that the Fed funds rate might actually get kicked higher, not cut. And the last thing that we want to touch on today is the first quarter GDP. Last month, we probably talked about the fact that first quarter GDP was 2%. No, it just got revised down to 1.6. That's a 20% reduction in what they thought the economy did for the first quarter of this year. So I would argue that when you look at the value line geometric average and you look at the economic data, that is indication that we don't have a robust, thriving stock market and robust, thriving economy. It's definitely some bifurcation out there. Oh, and by the way, bonds are still not safe. This is AGG, the aggregate bond ETF, and you can see that's a clear downtrend. You've got a series of lower highs. So that's not a positive trend for bonds. So if we would argue that we might be in a high risk environment, we'll talk about that, but you can't go and increase in your allocation of bonds and think that you're safe, because that's certainly not true. So in summary, I would suggest that we are in a high risk but bifurcated market rally. Now, I'm talking to Braxton earlier today before I shot this video, and he doesn't know that we can say high risk, but definitely bifurcation. We're definitely seeing some sectors thrive and other sectors not. So I'm sticking with the high risk mentality simply because underneath the surface, I see there's definitely some concerning signs. So as far as our tactical models are concerned, we're going to proceed with caution, because overall we do see some unhealthy enough signs that we need to participate, but we need to proceed with caution. And again, to succeed over the long term, sometimes it just means you have to survive in the short term.